ladies and gentlemen. Welcome to the Money Mentor podcast with your host, Graeme Holm, aka Australia's original money mentor. And again, we have the amazing Dr. Andrew Wilson. Now, who is Doc? What has he done? He's currently the chief economist of My Housing Market, previously chief economist of Domain Group, and a whole heap of other very well-respected organisations. Qualifications-wise, why do you need to stay tuned? Well, most of you know, but if you're not aware, Dr. Andrew Wilson holds a Doctor of Philosophy in Housing Market Economics, Master of Science by Research, Graduate Diploma in Economics, Bachelor of Construction Economics with a distinction. He's a smart cookie. He's also a member of the Royal Institute of Chartered Surveyors. So I'll leave it there because if you add all those letters up, he's got more letters after his name than I have in my legal 3 birth names. So good morning, Doc.
Yes, good day, Graeme. Here we are again. I think we're dead set in the middle of the month now, which means we're dead set in the middle of spring. So the spring selling season has unfolded, and we're certainly continuing to get a lot more positive results than many have anticipated. So, the scary thing is we're only a hop, skip and a jump away from Christmas, mate. So,
I know. That is a little bit scary, but you know what's not scary? All the positives in the market right now.
Yes. Well, we've sort of been predicting it. We wouldn't call it yet, but I think we're getting close to it. We've got a few challenges coming up over the next few weekends, Graeme, particularly next weekend. It's the traditional Super Saturday of auctions in Melbourne. Of course, the following weekend in Melbourne is the Melbourne Cup long weekend holiday. And as we usually see every year, agents obviously avoid the clash with that weekend, which is fun and games. And we get lots and lots of listings coming through. And it's also, really the epicenter to some degree of the spring selling season. So it all works together with a positive vibe for next weekend with lots of auctions. But I guess a lot of the buyers and sellers and the agents will be hoping they don't have the sort of weather that they've had down there over the last week or two. So shout out to Melburnians who've been affected by those floods, and let's hope that this weekend is a lot brighter and sunnier, not just for the weather, but also for the market.
Absolutely, but especially for the weather. They've had it pretty tough in some of those areas. So fingers crossed it dries out for them pretty quick. So speaking of markets, what's happened over the last week, Doc?
Well, look, obviously we always start with that weekend auction market data, Graeme. It is a very reliable forward indicator of what's happening generally in our housing markets. And look, we had another big result for the Sydney market. We're on the cusp of hitting 70% clearance rates in Sydney. Who would have believed a couple of months ago it was struggling to reach 60%, in the mid-50s at one stage. But it certainly climbed back off the floor, the Sydney market. And we've discussed that usually when we get to 70%, we're moving out of the neutral zone, if I could call it that, between buyers and sellers. And then it starts to favour sellers, more competition amongst buyers for property, and that can mean upward pressure on prices. So at 68.3%, that was a good result, another good result for the Sydney market. Auction numbers were down a little bit. But no surprise there, because the previous weekend, of course, was the bounce back from the public holiday long weekend that began October. So more good results there for Sydney. Will we get a 70% clearance rate this weekend? Will the market consolidate? These questions will be answered, but there's no doubt that Sydney market is bouncing back.
That's a great result. I mean, week on week, Doc, Sydney's it's hanging on pretty strong.
Well, it's come back, Graeme, really. I mean, when we look at the Melbourne market, and that had another, good solid result at the weekend, mid-60s, clearance rates auction numbers a little bit lower than we had the weekend before, but still a good test for the market, still some options there for buyers. We really haven't seen the middle to higher price areas in Melbourne at full spring force so far, but I think we'll see that this coming weekend. So another good result for Melbourne. It is the great survivor in a sense, that its clearance rates certainly haven't plumbed the depths that Sydney markets has. And it's really continued to be in the 60s over the past few months. In Brisbane, another typical Brisbane clearance rate, under that 50%. We're not getting a lot of reported listings or sales coming out of Brisbane, Graeme. So that's the reason why we're getting some lower clearance rates, some more volatile clearance rates out of Brisbane. They're holding back results for some reason, but nonetheless, no surprise that the Adelaide market keeps on keeping on. It's sort of like ho-hum, another 80% clearance rate in Adelaide, very strong, and auction numbers were quite reasonable, down a little bit again, similar to other capitals over the weekend. And Canberra, another good result there for Canberra. It's picked itself up from those low 50s it was reporting some time ago, but again, lower numbers of results coming through out of Canberra. But this is genuinely a spring market, Graeme. We are seeing a revival that we do see after winter, notwithstanding all the negatives that we've had in terms of higher interest rates and, of course, the issues over confidence that's being driven or has been driven by a lot of negative media. But that negativity seems to be shrugged off by the market, Graeme, and it's moving onwards and. It's a very positive environment. And look, for those that have thought the old sense of, hey, I want to pick the bottom of the market before I get back in, well, you never know. If you wait a little bit longer, you might miss it because it's certainly showing clear signs generally, particularly in Sydney, that this is a market that's revitalising. And we know that a number of the, key drivers are starting to improve. But we have looked some other quickly correlating data that supports a reviving market. And as we usually do on a weekly basis, we just look at some of that prices and rental data and the days on market data.
Absolutely. Let's do it, Doc.
So we've seen also, Graeme, when we look at the median asking prices on a daily basis, that Sydney median asking prices picked up over the past week for both houses and units. Melbourne reasonably steady for both houses and units. Brisbane a little lower, but we know that Brisbane market has been easing, but Adelaide, reflecting those higher clearance rates, it has seen an uptick in median asking prices over the past week, and particularly for houses. And similarly, we've seen an uptick for both houses and units in Perth over the last week. So again, supporting evidence that the markets are blooming in spring and certainly coming off that underperforming winter period. House prices, monthly house prices over the past week, monthly house prices are continuing to show improvement based on the previous month. So even though prices are still falling, they're certainly not falling at the same rate as they were over previous months. You can see the clear trends there in all the capitals, Graeme, that are showing an improvement that, we've bottomed out in terms of the level of decline in house prices in all those capital city markets. And if that trend continues, we might even get back to around zero by year's end, but some water to go under the bridge until that occurs. We can see just an uptick with average days on market in Sydney. Now, that sales versus listings data can show some volatility, particularly when we've come through holiday periods, as we have through that Sydney market. But certainly days on market have improved in most of the capital city markets on trend.
I've got to say, Doc, I know we're coming into spring, but even the lead up in it, it's been fairly stable. You go back, you've got 4 weeks of data there. It is fairly stable, and the market really has recovered and stood up and settled somewhat.
And I think this reflects that we just haven't had any of that real sort of panic environment in the market through this correction period. It's sort of eased because of the booming prices and higher impacting affordability earlier this year. Then, of course, interest rate rises came along. Shock, we hadn't had one for 11 years nearly. And, of course, we got a lot of negative press in regards to the prospect for housing markets and house prices. That's looking yet again very flaky, those forecasts. Be interesting to see which one of the big banks or the forecasters are the first to break ranks and alter their forecasts. I think that's...
You mean they're going to give a realistic forecast, Doc? They're going to eat their hat, you think?
Well, it's going to be after the event, Graeme, so I'm not sure
true.
What the value of a forecast is once it's not a forecast, because it's happened. You know what I mean?
It's a history lesson.
We might be seeing that. But, yeah, look, it's been a steady market in difficult circumstances, particularly for confidence. And I think buyers and sellers have largely shrugged that off. And maybe they've become a little bit immune to all the doom and gloom that we got through COVID. So they're taking things a bit more in their stride, a bit more perspective over it. And of course, the drive behind all this, and I think everybody's forgotten, of those forecasters that were looking for the clickbait, have forgotten we've got this tremendous economy, at the moment. And I think the economy is really, sort of continuing to lift confidence. Retail sales are still high. We're going to get the unemployment data out this week, Graeme, of course. That's the unemployment data for September. And even our unemployment rate ticked up marginally over August, up to 3.5%. It's still at record low levels, and it'll be interesting to see what happens with the official data when it comes out this week, and that's for September. So regardless, it would surely be another record low result or near record level.
And interestingly enough, Doc, I don't want to give too much away, but most people are thinking, oh, well, everyone freaked out. And you coined a bit of a phrase we've been using in our community of phobia, which was the fear of being involved. And we did have a strong period of phobia, the fear of being involved, interest rates, clickbait, mainstream media, press headlines. We're now sort of going back, I might call it early to FOMO, fear of missing out.
Yeah, well, it'll come along because, people are, we've still got this great economy. People's got a job. Employers are chasing employees. Wages are rising. And you're thinking, well, what am I going to do? Sit here and take it? Shouldn't I be taking advantage of my increased spending power and prosperity and get on with what I was going to do? So what we see, of course, Graeme, is that phobia, fear of being involved, once it eases and people start thinking, hey, this isn't as bad as what it seemed to be, and oh, gee, there's another salt sticker down the road. What's going on?
Phobia almost leads into a bit of pent-up demand, Doc. It goes from phobia to FOMO much quicker up than it settled into phobia. The FOMO drives pretty quickly, doesn't it?
That's right. And that's because we are releasing demand that has been, I guess, in a way, artificially restricted. And so when people say, oh, I was going to buy a couple of months ago, I decided to wait and see because, there are all these forecasts of terrible outcomes in the housing market and the economy. Well, hey, things are great for me. I don't know about you. And gee whiz, that's a cheap price over there for the house. I'm going to get in before I miss out. And that's when we do start to see clearance rates rise. And you're absolutely right, Graeme. It becomes self-fulfilling. The market rebounds. And part of that rebound certainly is the regeneration of demand as that pent-up demand is released. So that'll be the story to look out for over the next month or two as we move through spring, Graeme.
And another story, Doc, I probably don't want to give too much away, but we might come to this soon. But I think today when people are tuning in, they're going to be surprised at which section of the market is growing as a purchasing unit. So is it first home buyers? Well, clearly not. Rates went up and this and that. Is it investors taking advantage of high rents at the moment? Or is it, owner occupiers? Like there's some really interesting data at the moment where I think people listening and tuning in are going to go, what the heck? Hang on. Maybe it does make sense if things have settled a little bit. So we might even jump over to that, Doc, and just touch on who's actually been buying or where's the growth at the moment in which section or sector of the market. I think that'll be important. And also in relation to home loans. So who's, what's happening? Are we still borrowing? Is it crashed? Where are we headed there? And then who are the borrowers and the buyers?
Well, yes, Graeme, the latest home loan data from the ABC was certainly very interesting. Of course, no surprise that home lending fell over August. We've seen that downward trend. We shouldn't be surprised. Higher interest rates are obviously sidelining buyers. We've come from an extraordinary record period of activity in terms of home lending. Not just the value of home loans, but also the volume of home loans has been at record highs. Some ups and downs because of COVID shutdowns, but nonetheless, we did see another fall in home lending over August, but really it was only a marginal fall, Graeme. The level of home lending is still quite high in dollar terms compared to where we've been. So even though we've seen falls, but maybe an early sign there that we're also starting to see an easing in the decline of home lending with that slight easing over August. But as you were alluding to, Graeme, we saw some very interesting data in terms of the actual buyer types for home lending over August. We can see owner-occupiers were down. No surprise. They're obviously affected by affordability. And, of course, a lot of the pent-up demand we spoke about through COVID has been released now, and higher interest rates are also impacting affordability for owner-occupiers. But this was the real surprise, and that's first home buyers.
Wow.
They actually increased, Graeme, over August. So who would have guessed? We saw,
and that's a decent, that's a pretty steep, that's a decent increase, Doc. It's not pretty flat. That's a jump.
It's not, Graeme. And even when we look at investors, and I think there's a little bit of restrictive lending heading back into that investor market, but that's another story. But investors were also down similarly to what happened with owner-occupiers. But there's no doubt that first home buyers went against the trend over August. It was a bit of a surprise because you would have thought higher interest rates and negativity were affecting first home buyers. But let me tell you, Graeme, don't let a first home buyer, or don't let anything get in the way of a first home buyer in their first home, because they have tunnel vision when that's concerned.
But it makes sense, Doc. You're right. They do have tunnel vision. It's the great Australian dream. Yes. And hey, if you don't have a trade, if you're not selling and buying and worrying, if you were going to buy in Sydney or Melbourne's maybe down 6 or 7% or 8%, now's the time to buy, right? It's only upside from here.
Well, this is the point, Graeme. I mean, lower house prices are the best news that first home buyers can have because lower interest rates, they're good news too, but that means everybody else is out there buying as well. And you've got to pay higher prices because of those lower interest rates. But now we have lower house prices, which is obviously a hook for first home buyers. Now, there are other factors here, Graeme. We've had an extension to the first home buyer deposit scheme, which allows qualified first home buyers to purchase a property with just 5% deposit, with the Commonwealth covering the insurance, the mortgage insurance. That's been extended substantially. And of course, that came into force on the 1st of July. I think we're seeing some results from that extension, the extension of that policy. We mentioned lower prices as well. But of course, the booming economy is also helping first home buyers. They're getting higher wages. They've got no problems with job security. So no surprises there, Graeme, that first home buyer numbers have increased. And when we look over the results there, you can see over the month, first home buyers were actually up by 7%.
That's crazy.
They're still well down on where they were this time last year and over the full year. But certainly, it's the first sign of a revival in first home buyers. And we've been saying that they're part of the strength of the market or the likely support of the market because of those factors. And of course, the other thing I didn't mention about first home buyers is who'd want to be renting at the moment, Graeme,
Oh, no way.
It's the biggest incentive, I think, is paying, extra 20% per year plus in some of those markets for your rental,
I'll tell you what, Doc, if there's any mainstream media or press going around that is heightened and sensitized but is accurate, it's in relation to rental stress and accommodation. And that is accurate reporting at the moment. It is tough. It is scary. I mean, the 50, 60 people are turning up to open homes and half of them are just turning around and walking away.
Yeah, that's right. So, it's all working, all those factors. I mean, wouldn't you rather be paying your mortgage than a rent, And
that's not going to settle anytime. You're right. That's not going to settle. So there's a good expectation. We'll see that figure for first home buyers jump significantly again because rents are absurdly out of control. It's better for them to own.
And, the other thing we should consider, Graeme, is that with investor numbers falling, that's not good news for the rental market either, because that means less investor supply coming through for residential investors. So that's only going to put more upward pressure on rents. And we know on the demand side, we've got borders open again. And, we're getting international students and international residents flooding into Australia at the moment. And that's only going to mean more demand from less supply in our rental markets and higher rents.
Well, let's face it, Doc. I mean, we had Queensland trying to push through the land tax but wheelbarrow, and that's been scrapped. And none of the other states were going to volunteer any information. It was never going to work, thankfully, touch wood. But if any of the states or territories or any areas were serious about this housing crisis, they'd be doing something to stimulate investors, not trying to introduce new taxes and levies. And we'd be incentivizing investors, private investors, Bob and Mary, to get homes in the market for families to rent. We'd be incentivizing them not to be doing holiday let and all these other sorts of things. But here we are.
Yeah, that's right. And you can see there, Graeme, the market share for first home buyers is just about spot on the long-term average, which is interesting given we've come through this, period of adjustment. But the investor market share is still below long-term averages here. So we're not even replacing at an average level the number of investment properties, in the marketplace. So, it's all working for those that actually do invest because or can get their investment loan up because, this is only putting more pressure on rents, which increases yields, which provides more certainty for investors going forward, higher occupancy rates, so you're not worried about shifting tenants, those sort of bits and pieces are all positive for investors. So again, more signs that the market is reviving. And I think that was a very interesting result for home lending, Graeme, over August. We see New South Wales is still the top destination for investors, no surprise there. And first home buyers, as usual, are strongest in Victoria. We've also seen refinancing rising quite strongly, Graeme. Again, no surprise there. People are spooked by the prospect of rates continuing to rise. So another record number of refinances over August. And the refinancing market share is also climbing as a proportion of all lending, and it's just below record levels recorded during COVID. So, the home loan data is another correlating factor that our housing markets are now certainly reaching for the bottom of this adjustment cycle and going forward.
And sorry, Doc, just on that last slide, there's an interesting trend here. That's owner-occupied refinancing.
Yes.
That's actually rising steadily and at a lengthened period. That also demonstrates, even with these interest rate rises, mum and dad are still employed post-COVID. Yes. They've still got a decent enough income and equity position to refinance and reposition themselves.
That's right. So it's their call,
Yeah.
And they're able to make that call because their financial position, is strong. So
everyone tuning in at home, this slide Doc's got up right now. You can see the trend of people improving their position, looking to save money, and the bank is saying yes. It is half the market is owner-occupiers. So don't sit on your hands because you can go and get a better deal as everyone else is, as per the data here.
That's right, Graeme. So this will all be reinforced this week by our latest unemployment numbers. So watch out for those. I think we'll again have we'll certainly have a low number. And this just is the primary reason, in my opinion, why our markets have had just a real shallow, look like having a very shallow correction period. And that, our strongest housing market, which is Sydney in terms of prices, led the market up last year. It led the market down this year early. And now
it'll probably lead the market back up next year or the year after.
Leading the market back up again, Graeme. So stay tuned to this space.
Yeah.
Get all the information every week about exactly where we are and where we're going.
Excellent. And Doc, so unemployment's coming out next week?
Yes. Well, this week, Graeme. Yes.
This week. Unemployment's out this week. Yep. What are your expectations around that, regardless of the outcome? You think it'll be pretty similar?
Well, I think the low unemployment rate has been part of the reason why the Reserve Bank didn't raise interest rates by 0.5% last month, or this month, and only went up by 0.25%. But I also think that they've been careful not to, throw out the baby with the bathwater. The low unemployment obviously works its way into higher wages and therefore, can mean businesses putting up their prices, which means higher inflation, and that can then act as a catalyst for employees to put up their wages. And that's what we're trying to avoid, that wages prices spiral. But our inflation rate is certainly lower than just about everywhere else. Our wages growth is just about lower than everywhere else. And our unemployment rate is as low as anywhere else. So far, so good. And that's why our interest rates are lower than just about everyone else. And like I said, so far, so good. But that unemployment data will tell a story. But, there need to be some, other signs of declines in our economy, such as retail spending, to support any sense that a shakeout is coming. But it would only start slightly. But the point is that if we were getting a shakeout in our economy, the Reserve Bank has already signalled that the interest rate cycle is maybe coming to an end, Graeme.
And Doc, just looking at some current economic data, you've got a slide there in relation to inflation and wages and GDP. We might jump to that before we wrap up today, just to give people some insight and you explaining the context of the data about what's happening for inflation. So, looking at Australia and New Zealand and the UK, US, Europe, etc. I think that'll be handy for everybody to understand, where are we positioned in comparison to the rest of the world? And, some people, I had someone the other day asking me, well, if Europe's inflation's out of control, why is its interest rate so low? They couldn't understand, well, why are we putting rates up if we're trying to control inflation, but Europe's is so low? So if you can just take us through this, Doc, I think it'll help all the listeners.
Well, I think the point about Europe, Graeme, is that Europe's not a country. It's a
conglomerate,
conglomerate of a number of nations, and some of them are doing okay, like Germany, and some of them aren't doing that well, such as Greece, as an example. And I think that's the factor that, you can see inflation and prices are growing, and that's a COVID thing and an oil thing everywhere. But that doesn't necessarily mean that, interest rates are all in sync. So that's a sort of an average interest rate of all those countries rather than the interest rate for all of them, if you understand what I mean.
Great explanation. So for anyone who was confused by that, understand it's not a country, it's not Australia. It's the equivalent of saying Australia, Tasmania, New Zealand, Papua New Guinea. It's multiple countries in Europe, yeah. So the data you're seeing there is averaged out. So don't get confused by that. So how are we positioned, Doc?
Well, you can see there that in every measure we are basically better than everywhere else. The UK has a slightly lower interest rate than us, Graeme, but of course the UK's got some horrific problems at the moment. They're going to have to increase their interest rate because their inflation is climbing significantly. They've got real political issues over the new Prime Minister. She's already changed her finance spokesperson. That's a bit of a mess over there, Graeme, and I don't think that interest rate differential will last too long. The US is in big trouble over its inflation, even though its headline inflation improved over September. Its underlying inflation increase, and that takes out oil and food prices, to the highest level in 40 years, and that's the measure they use. So they will definitely, almost definitely be increasing rates by 0.75%.
Wow.
In their next meeting in 3 weeks' time. Jobless is just about the same every week. See how the jobless rate is higher in Europe, Graeme? Again, that reflects the differentials in the economy. You can't have a 6.5% unemployment rate and a high inflation and a higher interest rate as well. Again, that's an average sort of scenario. It's or even if it was an aggregated scenario, it still reflects what's happening at a different level in so many of the different countries that make up Europe. But our GDP is higher and our wages growth is lower, and that's the real secret to everything, is that at this point anyway, our wages aren't pushing inflation. So that's why we've been able to manage things at this point. It look like we may be peaking a lot sooner and a lot lower than expected.
So in summary, Doc, to wrap up for this week, what are you feeling? I mean, we sort of said we might be calling it. It's not as shallow. It's not as steep, and it's a bit more shallow. Sorry, it's not as steep and deep as we thought.
Yeah.
Where's your brain going based on the data and the trends you're seeing at the moment? What are you calling?
Well, it's positive territory, but there's no doubt about that. That's what the data is saying at the moment, Graeme. We've got a few hurdles to get over. Super Saturday this weekend in Melbourne, but all things being what they are, Australia is in a better position economically than most. Confidence is returning. We see that in retail sales, still high, and housing markets are lifting. There's no doubt they're lifting, Graeme, particularly the big markets of Sydney and to a lesser degree Melbourne. So watch this space, and we look forward to those results from this weekend, not just the auction results, but also what happens with unemployment this coming Thursday.
Look forward to it. And we'll see you, Doc, live in person on Friday at our Queensland Real Estate Mastery event.
Yeah, that'll be a lot of fun, Graeme.
Absolutely, as always. Appreciate it, Doc, and thank you. We'll see you next week. We'll see you Friday.
See you. Bye.
Thanks, Doc. Well, there we have it, ladies and gentlemen. Brilliant and informative from Doc Wilson, as always, and sometimes not too bad myself. Hopefully you found that extremely informative. And for those of you who are tuning in regularly, don't forget to check the show notes. And if you are looking for a bit more financial education and financial literacy, and you'd love to spend 2 days with people like myself and Doc Wilson and chartered accountants, etc., I encourage you to go to money-mentor.com.au. And I'd love for you to be able to use the discount code podcast1500. That's podcast1500. And you'd be able to spend 2 days with people like Doc and myself. That's usually $2,000. It'll be just $497. Have a look at the show notes, ladies and gentlemen. Look forward to seeing you soon.